Hi, I'm Dominic Picarda here for the April edition of Spreadbet magazine, and today I'm going to be taking a look at the US Nasdaq 100 index, home to some of the world's hottest technology and other new economy companies. Now, Wall Street as a whole has been on fire for pretty much the whole of 2013, or most of 2013 to date. The Dow Jones index has soared to new all-time highs. The S&P at the time right now is not far off doing so, and I see this trend continuing for now, certainly. By contrast, the Nasdaq, as we can see, has been much less impressive in 2013. It got off to a pretty dramatic start to the year when we had this big gap up, which is a huge sign of strength in the market. But since then, the progress has been much more muted. So while we have the Dow Jones ahead some 13% from its lows of the 31st of December 2012, this index is only up by around 8% at its highs. So the old economy Dow Jones, if you like, has outpaced the new economy Nasdaq, and this isn't really what I like to see in these situations. I'm pretty bullish at the moment on the outlook for Wall Street. I've been bullish for a number of months, and in these situations I like to see the tech index, the Nasdaq, leading the way higher, because when you get the Nasdaq leading, it shows that there is a real bullish conviction on behalf of traders and investors, that they're embracing the raciest and higher risk stocks in the market, and that's what you would expect to see in these situations. So basically, some people are suggesting that because we've seen this much weaker performance on behalf of by the Nasdaq, this is a sign of weakness, or underlying weakness in the market, and maybe the Nasdaq's misfortunes could end up impacting the other indices. So, is this really a warning that we're seeing here? This sort of performance, and I would actually say no. Because the performance of the Nasdaq this year, which has this rather ugly, spiky quality to it, is being unduly or heavily distorted by the woes of just one company. Historically, or in recent years, its most important constituent, and of course I'm talking about Apple, which has really been in the wars just recently. If we call up Apple's chart, you can see exactly what I'm talking about. Since the highs of back in September, the all-time highs here, Apple has gone from around $700 a stock and collapsed down to a recent low of $430 or thereabouts. And this has had a profound impact on the overall Nasdaq 100. Even after this fall, which has been really severe at a time when the Nasdaq has been gently rising, the Apple still makes up more than 12% of the overall Nasdaq. So what's bad for Apple is still is bad for Nasdaq. It has a drag on the index. At the height of its valuation last year, the Nasdaq was made up more than 20% of the index. Obviously, that's progressively fallen over this period. So, how is the Nasdaq doing if we strip out Apple? I mean, I think that gives a much clearer picture of the overall trend, even though this represents the economic reality if you are trading the Nasdaq. What I've done here, I've just knocked up a very simple chart where I've got the blue line, which represents the Nasdaq's performance as it has been, and then this is the sort of Nasdaq as it would have been without if we take out Apple. So, as you can see, the performance would have been much better if had it not been for Apple. So it's not that there is a general malaise in technology stocks. This is pretty much an Apple story. So there's plenty to be bullish about outside of that one company. The Nasdaq would be in pretty good shape. So, what is the outlook then for the actual Nasdaq index, which of course does include Apple, and we can't ignore that reality. And I suppose if you're a bear, you would now argue that we've got some sort of big topping pattern tracing out here, because you've got what a lot of people would identify as a head and shoulders reversal pattern. And what the implications of this would be would, if the Nasdaq now collapses through this line that I've drawn here, connecting these two previous lows, and you could get a down move of some 400 points or so from that level. So somewhere into this range, into the where the lows of 2011, or the middle of the range from 2011. And I suppose in a big sort of market pullback situation, that's perfectly feasible. It's not really what I'm expecting right now. I remain very bullish on the outlook for US equities in the months ahead. Yes, I think we'll get a correction because the markets are clearly quite stretched. Well, not the Nasdaq, but certainly the S&P and Dow. They've got to kind of overbought levels. But with all that liquidity being pumped into the system from the Fed, I really want to be on the bullish side of this trade for now. For the moment, I would focus my attentions not on the Nasdaq, but on the Dow Jones. That's got the sexiest chart of the lot at the moment. It's breaking to all new time highs. That's inherently bullish. Whereas the Nasdaq, I think if I'm right about the other two indices, it will get dragged higher, even if Apple does continue to struggle. Sooner or later, though, I would expect a big snapback in Apple. I don't follow the fundamentals of this company very much, but I know it now to be looking very cheap on a number of metrics. So sooner or later, you've got an overbought, good value stock, which is going to have a big bounce, and that could be what is needed to drive this up to new bull market highs. I see it going to 3,000 and above when the turn comes. So my message would be, for the moment, focus on where the action is. That's the Dow Jones, and to a slightly lesser extent the S&P. Keep an eye on what's happening in the Nasdaq, and specifically what's going on with Apple. When that thing begins to bounce, we're going to see this thing play catch up in a big way, I believe.